Hello and welcome to the Farming Banker podcast. This is Jeremy Dutch, the Farming Banker. Just wanted to continue on, and this is what we're going to be doing here is part two. So you guys have heard part one, or hopefully you've heard part one. If you haven't, go ahead and put a pause on this, go back and listen to, or better yet, would be to view it on YouTube. Part one of this series, which is how to get your house in order, and it's a banker's view or perspective at how to handle your lending relationship and roll out this financing toolbox that we've created in partnership with AgView Solutions. So last time we talked about part one, the two steps within part one, which was the first step was to understand your cost of production. The second step was to start your marketing plan. Even if you didn't have anything sold, you could start putting in some target prices. Potentially if you had some, options out there that you would include on that, all those types of things. So this next part two is also going to have three steps really. And this is a time frame, where I'm thinking after harvest, you've got your machinery put away. We're doing year-end information, office stuff. And this is where, I think this is where part two you got to do some work in part two. And so part two is going to be, first step is going to be getting your balance sheet accurate, your year-end balance sheet. If you have a goofy year-end, obviously, the time frames that I'm keying up here aren't going to exactly work with your time frames, but I think you can adjust it accordingly. What banks really like to see is an accurate year-end balance sheet. And so before I bring one up, I just and go through it, I just wanted to kind of express and talk through the reasons why. What's really important to the banks is they want to be able to get down to what was the value of farm production. And sometimes that can be hard to figure out exactly what that is for that growing year. And the reason why is because you could be faced in one year with the prospect of selling two crops in a calendar year, depending on whether it's carrying the market, what your plans are. You could also be faced with 2 years worth of expenses if you bought all your prepaids in one year. So, it from a cash basis of accounting, your numbers can be highly skewed due to when you sell grain and when you purchase prepaids or pay for your expenses. And so, to help stabilize and flush some of that out, what banks like to do is year over year balance sheet adjustments to the income statement through accrual adjustments is really what they call it. They call it accrual adjustments to try to help flush out if you sold 2 years worth of crop, if you bought 2 years worth of expenses and didn't have expenses the following year, all those types of things. And so from being able to get averages and start leveling out exactly where your net value of farm production, the balance sheet is absolutely critical for this. And so a couple points to this before I end up going into, a sample and just kind of going through it. I mean, this part of it is just more informing, things of kind of a banker's look at what we're looking at. Maybe some real quick missed things that, we typically see that we got to go back and reconcile. But what's real critical is to make sure that you're filling that balance sheet out at the same date every single year. And so, for example, don't fill one out on 12/31 and then fill the next one the following year, as of 2/1. I know that in a farmer's perspective, it's probably like, what does that matter? There's not, anything that's changed, and maybe it hasn't for you, but I can promise you that credit departments, credit managers, that type of thing that just makes their head explode. So if you can take one thing away from this podcast, it would be to do an accurate balance sheet as of the same date at the year end. Try not to recreate it 3 months from now. That's where we see a lot of problems. We see a lot of problems 3 months from now where, oh crap, as of February, I misplaced 10,000 or 20,000 bushels because I sold it, January 15th. And I created my balance sheet as of what my, inventory percentages are today versus what it was as of 12/31. So to avoid those two things, make sure you do it as close to the year end as you possibly can. And make sure that it's, effective date is the same date every single year. And preferably that effective date is at the end of your business cycle or your fiscal year end, which again, most of them are calendar wise. So anyway, so that's step number one. Step number two is a debt schedule in filling that out. And I think that why I think this is really important, for a lender and yourself is that, you may have a loan covenant that wants to calculate your debt service ability or the ability to service the amount of debt that you have. And sometimes you may purchase something after the first of the year, but it may not have a payment until the following year. You need to have an accurate reflection of that. Similar to the income side, it's the accurate picture of what your debt was through the debt schedule as of 12/31 as well. So make sure you've got, where you're filling that part out and you're figuring out principal balances owed, what they are, rates, when they're due, when the payments are due, type thing. And then the third and final step to this piece is starting to put together your financial ratios. Those are really good metrics and metrics that the bank really pays attention to. So I would urge you to start paying attention and figuring that out before the bank figures them out for you. And so we've got a bunch of calculations that you can do here too. So those are kind of the 3 steps for this part 2. We're going to go ahead and share our screen and start walking through some of this. So here's a copy of a balance sheet. Let me get it pulled up here. And so here's here's what I'm kind of wanting us to work through. And again, this is, I think, is step 1 in the part 2 of this deal. And a balance sheet, again, is one of the most important things that you can fill out for one of your loan renewals. And so I'm sure you guys you've all done it before. You've got an accounting, potentially an accounting software that does it for you. If you don't, this is a copy of a balance sheet that, we can get to you, that AgView Solutions has. I like this balance sheet. There's multiple ones out there. So what I thought I would just do is go through and talk through some of the stuff that I typically see mistakes on, and make sure that this is that we address it, make sure you guys don't have the same thing. So, one of the big deals, and I'm going to go to the supporting side of it right after I talk about this, but this accounts receivables, crop inventory, and prepaids, get those extremely accurate. And where I see mistakes, if I get up to this part of it, is it, under accounts receivables, in this example, if you're following along on YouTube, we've got accounts receivables that show, other income that's in the hedge account, other farm income, could potentially be what's owed to you guys for custom hire, crop insurance. And a lot of the times what we'll see, and this side of it, and what I like about this balance sheet is it says, crop inventory and receivables. What we'll see farmers do a lot of the times is that they'll sell something, at the end of December, but not take the check until until the previous year. And so a lot of the times what ends up happening on your balance sheet is that as of 12/31, you don't account for it in your crop inventory, and you forget to put it up in your accounts receivable. Or again, it could be out of accounts receivables. You could put it in there and keep it in your crop inventory. Just make sure that that reconciles, that your crop inventory, if you do anything like that, just to make sure that you're picking up exactly, the true picture of your current assets. And I would say that same thing with this, prepaid side, is it make sure all your prepaids that you have purchased, that are in this section of there, and make sure you reconcile that. So, on the bank side, a lot of the things that we do, we will reconcile year over year accounts receivables, crop inventory, prepaids, in other types of current assets. So that would be kind of issue or number one, of what we end up seeing that potentially can derail us, on trying to get an accurate representation. The other part of it is in this, equipment section. And these are the most common is you skip something in the current assets, there, or you skip something in these intermediate assets. And, a lot of the times we'll purchase something, at the year end, for tax reasons, accelerate the depreciation, whatever the case is, but we won't put it on our balance sheet. We'll forget to do that until the following year, when we've had a chance to use it. So, one of the things that I would make sure, and this kind of goes to, what AgView Solutions likes to do, is to get some form of, accurate representation of your equipment value from a fair market perspective. And one of the ways to do that is that you get an equipment appraisal every year, or you get a couple dealerships to give you some, auction price, or, whatever the kind, whatever, price you can get from them. But if you go through your whole equipment list and you do this exercise, it does a couple different things for you. One, it makes sure you don't miss anything that you currently, purchased. But then the values that you have for this year turn into the values that you put into your profit manager, so that you can look at your true economic cost per pass. And so I think those things are important and notable to talk about the balance sheet. And so, I kind of missed a important step on your balance sheet too that I want to clarify. And so I said, there's a couple things that are important, is it to do it, at the same date every year, do it as close to year end. And then the third piece before we wrap up the balance sheet is to make sure you do the same method of valuation. And, Chris Barron and myself, and several others within the ag industry, we've talked about this a lot, that says, hey, what kind of method of valuation do banks want to see? And I think you're going to find out that that's across the board very different. But what we really like to see is consistency. So if you're doing a fair market value, balance sheet, continue to do a fair market value balance sheet. If you're doing cost, continue to do cost until you're prepared to take the steps to do a fair market value balance sheet. And so a fair market balance sheet, what I would say is that's important about that is that you are doing that exercise. You're getting machinery appraisal every year, or you're getting some form of valuation of what the fair market value is every year. If you're not going to go through that exercise, stick with cost and what your accumulated depreciation is out of your QuickBooks or something along those lines, if that's what you prefer. But those are some of the most common things that I see with balance sheets that give, banks problems, and why it's important to do that as close to the year end and the same time frame every year. So that pretty much wraps up, your step one of part two, is to do an accurate balance sheet. And if you can start doing it before year end, obviously it can't be completed, but I would do it as close to, the first week of January as you possibly can, to make sure that thing's true and accurate. So I think that wraps up the balance sheet. Let's talk about the debt schedule. That's the second piece. And so this is, one of the reasons why I really like this debt schedule, and we created it, was just for its simplistic, nature, and having it being, just simple, and it gives you a good picture of what's going on here. And it's not encumbering on getting it filled out, but it's very useful for a bank so that we can figure out, a couple different things. One, the first one is that we get an accurate depiction of what your debt service coverage is. The second one is that, if there's opportunities or there's reasons that we need to recapitalize, we can start working through what makes sense based on the rate, based on what your payments are, and what you have left, as far as, the overall life of that loan. And so that's some information that not every single balance sheet, uh, basically calculates or has. So I would highly encourage you to fill out a debt schedule as of 12/31 as well. And so just a couple points on this. It's super easy. I would put all of your operating lines of credit that are up here, whether you use traditional financing or a combination of traditional financing and, John Deere Finance, or, who knows, whatever you use. I would put all that operating money up there, and I would put it out in every single loan. What drives bankers nuts is it says operating line of credit and it says $1 million. But, what it really is it's a combination of 600 with a bank, in 200,000 somewhere else. The rates are different, the terms are different, the maturities are different, all of the stuff is different. So please break that out and be as detailed as possible. I've just got a couple examples in here that show, a combine loan and a real estate loan, and then a sprayer lease. And this is the only other point I would make on that, from a lease perspective, is that if it's a capital lease, I would put it on the debt schedule. If it's an operating lease, please leave it off. And if you're not sure whether it's how it was set up, just call your leasing agent. They'll be able to tell you. But as you get done through this whole thing, and I'm just going to show you what it looks like when it's done, and I'm just going to pretend I'm printing a copy. The reason why I like this is because, you can see it says debt schedule. It's all printed out. But then I get down here at this section here, I see the total amount that's outstanding, and then I see your total payment amount. And both of those are dollar amounts that we're going to flip to the next section, step 3. And so it'll help you get that together. So I'm trying to do this in somewhat chronological order in office periods, throughout the growing season to make sense for you guys. So again, step number 2 in this part 2 is to create a comprehensive debt schedule that will allow the bank to see, the creditors, what the payments are, so that we can accurately, figure what your debt service is. And if we had to recapitalize, consolidate, or do something there, that we knew, what were acceptable loans to include in that package, what weren't, that type of thing. So that hopefully, not a heck of a lot that needs to be talked about with the debt schedule. It's pretty straightforward. The last step here that I like to do is, have you start to figure out what your ratios are. And some of this you're not going to have right away as of, January. So, I'm kind of going through, the time frame of this part 2, which is, December, January. If you get your balance sheet done and you get your debt schedule done and you're still waiting on your tax returns or your year-end income statements, you can fill out a fair amount of what these ratios are. And these are the ratios that I think you need to know. The 5 ratios that I think, every farmer needs to know is basically kind of what I'm calling this. And the first ratio here is your debt service. Again, you may not have that, until your taxes are filed. So if you don't have it, don't be, overly concerned about it. But there's a couple notes to this debt service that I just want to go over, in this whole worksheet overall. And that is, whatever you're using for your numbers, make sure you fill out in here. And so we would, as banks, we would prefer, some kind of compiled statement from the accountant, or your tax returns. And so, that would be, you put in your net income number here, your depreciation expense, interest expense. And again, you're inputting things that are the orange is tan and the yellow is self-computing for you. So it's, again, this here is just like your Profit Manager if you're using Profit Manager. Your total annual payments, if you've done a good job filling out your debt schedule, that number there will go in this total annual payments. And so I'm just going to do a real quick one. Let's say at $100,000 of income, and then you had $50,000 of depreciation expense, and you had another $50,000 of interest expense. So that would give you roughly $200,000 of cash that can service your debts. And let's say you had $150,000 of total annual debt payments. So if you look what happened here, this calculated a 1.33 ratio and it turned it green. And so basically what that means is that for every dollar in debt that the farm has, you've generated $1.33 in income or the ability to service debt. And that ratio turned green, meaning that that's a good. Now, if we took this and said, hey, you had $200,000 ability to service debt and you had $200,000 debt payments, that means that you generated a 1-to-1 ratio, and that's starting to become troublesome. And if you had $210,000 of debt payments, sorry, I put 2 million, didn't mean that. 210, then you'd have 95, percent of your debt was matched with income that was generated, or for every dollar you only generated 95, and that turned red. So as you start filling this out, when you get all the appropriate information, it'll give you an indication of whether that's good or not. And all of these ratios do that same thing. They're color coded for you to be able to do that. So, that's basically the ins and outs on the debt service. Working capital per acre. This is one that I really like. If you said you had $1 million of of current assets, and let's say you had $500,000 of current liabilities, that means you have $500,000 of working capital. Let's say you farm 1,500 acres. That basically tells you that you've got $333 per acre of working capital. And so let's go back to our corn. If you guys remember in part one, we talked about corn being $1,000 an acre to put that in. That means that you can fund $333 of that, and the bank's got to fund the other, or somebody, not necessarily the bank, somebody's got to fund the other 700 roughly. And so, you can play around and see where you fall on it, but this is why I think it's a good number to know, and to go from there. And so the rest of these, pretty much self-calculate. They're pretty easy. The only other ratio that I really want to hit on this is that, is your working capital burn rate. So let's use that same example. $1 million, $500,000 of current assets. See, if you're following along with me, you see that self-fills in the working capital burn rate. And basically what's happening here is that we're already calculating your working capital. And what you would do then at that point, if you're showing a loss, like you saw in part one, potentially there's a loss. I think it was like $47 on corn and $61 on soybeans. So you would put that projected net loss there as a whole number. Do not put any parentheses. Do not put a negative. It will screw up my calculation. So let's just say you were going to lose $100,000, for that year. That burn rate, that number 5 there, shows that under these conditions, if you were to continue to lose 100,000, that you would be out of working capital in 5 years. So as you can look at that and say, what kind of loss is it is starting to become troublesome. Well, if you used half your working capital in 2 years, that's not a lot of staying power, as we know ag cycles can, last, a lot longer than just 2 years. So that gives you, ideas of what we're looking at from the bank's perspective, why we take a look at some of these. And one of the things that I would say is that, if you're self-calculating all this stuff, and you are putting this stuff together and you have accurate balance sheets, you're starting to build a lot of goodwill and trust with your lender. And that's really the goal, is to keep them out of your business. The goal is for you to be able to run your business as you see fit. You are the best way to run your business. And the way to portray that to the bank's eyes, to have all your ducks in a row and have this done. So again, this is part 2. And so for part 2, in the January timeframe, comes in 3 different steps. Steps 1 is the balance sheet. Step 2 is debt schedule. And step 3 is to start calculating as many ratios you possibly can and understand them so you can talk through them. So hope this has been beneficial. Like I said in the last one, you guys want me to walk through any of this with you, help calculate it, I'd be more than happy to. Just reach out to me. You want any more clarification, shoot me an email. If you go to thefarmingbanker.com, that's the easiest way to get in touch with me. Shoot me questions. I'll answer anything you guys have. Appreciate it, and hope you have a good day.